Welcome to our macro and market outlook for 2020, which we've entitled Fasten seatbelts. Now, this refers to the crosswinds that we're likely to face of fiscal policy, monetary policy, and of course the ongoing trade battle between China and the US, all of which we think will conspire to lead to a mild US recession over the course of the year. So turning to our first point, Charlotta, monetary policy was such a profound shift last year. What does that mean, and what are we expecting for the coming 2020?
Yeah, it was very profound. 1 year ago, the Fed was still hiking rates, and they signaled further hikes over the course of 2019. Of course, they made a complete U-turn, and they have cut rates 3 times over the year. We think it's a good thing. They responded to slowing growth, which they should have done. And this has opened up really for emerging markets to loosen financial conditions, which helps to soften the growth projections globally. Going forward, however, we don't think this will be enough to materially shift the growth outlook. Many central banks are already pushing on a string. We have negative interest rates in many parts of the world. Liquidity is not really the issue for the global economy, and we have extended debt levels in many regions. So we don't think this by itself will be enough to shift growth into higher gear globally.
Softening the landing as opposed to kind of mitigating that downward trajectory.
Yes, softening the landing. And what we said for a very long time now is we need to see this stimulus mechanism to broaden out. We're too dependent on central banks to do all the action, and we need to see more fiscal policy coming through globally. I think you have strong views on this.
Yeah, I do. Another thing I have strong views on, but I think a fiscal impulse is surely needed. I mean, we've heard a lot of the central banks speak about this, and unfortunately it looks like we're getting kind of a piecemeal approach, a little bit coming from Japan, a little bit from the United Kingdom, but we're not seeing a coordinated and sizable initiative come through really to change.
It's quite clear that this is needed, and a lot of people are speaking about it, including the ECB. Yeah. So why is it that we're not seeing more of this?
Well, I think a key point is the level of debt. Government debt is still incredibly high. Debt to GDP ratios really are at almost unprecedented levels. So I think there's a reluctance to add to that. But I think the key thing is that you can take on debt if you're going to invest. Just think about our future generations. I think they'll look back and say, hang on a minute, you could borrow for up to 30 years and almost get paid for doing so, and yet you're not using that to generate growth on a more sustainable basis, to decarbonize economies, to create technology hubs, to build infrastructure. I think this is a hugely wasted opportunity for governments really to take that initiative and do that. So for this year, I think we're going to see bits and pieces coming through, but not enough, sadly, to ultimately change that dynamic.
And given the headwinds we have from the global trade environment, which is weighing on the private sector investment, businesses are very uncertain about the outlook for global trade. They don't know what the future trade system is going to look like. And we've seen this has been weighing on the global economy in 2019. And we can't really see that shifting into 2020. Yes, there is scope for a near-term trade agreement between the US and China. There are negotiations ongoing right now.
Which would be a good thing, clearly.
That would be a good thing. And it would help to support sentiment at a very critical time. But critically, the structural issue, which is about the emergence of China as a global superpower and efforts by the US to contain China, that's not going to go away. And we think this uncertainty will continue to weigh on the global economy.
And that will still slow business investment in 2020, another reason why we don't think there's going to be a kind of a pickup from these current low levels.
Yes, so and taking it all together, this is a key reason for why we don't really think the global growth, which fell very sharply already in 2019, why it hasn't quite bottomed yet. And we do expect a further slowdown in growth over the course of 2020. That said, actions and policy actions and trade issues will be decisive, and we need to look at what's happening in that front. Now, going back this year, we saw growth slowing very sharply, and despite this, of course, financial market and risk assets were doing very, very extremely well. We had 20+ gains in many equity markets. So given that, why do you think we need to hold on for 2020?
Well, as you said, I mean, 2019 was almost exceptional. We had all this liquidity that you mentioned from the central banks lifting all boats, whether it was equities or credit markets or even the property market. All these financial assets were rising, lifted by that liquidity generated. 2020 is unlikely to have that same dynamic. We see multiples being expanded. Really, earnings are very anemic still. And as a result of that, I think we're going to have more volatility within markets, more dispersions between markets. And as a result of that, I think it's going to be a much more challenging environment for investors. Remember, even though we're talking about only a mild US recession, when we look back historically, a mild recession typically results in equity markets, for example, falling by 20% or more. And that's something I think that we need to be prepared for in this coming year. Yes, take advantage of the opportunities when they're there, but also be prepared for a significant drawdown from a credit market perspective and also an equity market perspective.
And it sounds like in that environment, we could very well see bond yields slipping back down again.
I think so. I mean, I think that in that scenario, I think these bond yields will challenge the lows that we hit in 2019. Ultimately, I think as we see recovery and we see policy coming through, they'll pick up again, but I think that's very much a possibility for 2020. So to sum the whole thing up again, of course, there's lots of crosswinds going on. We do think it is time to fasten your seatbelt for the reasons that we mentioned. And of course, all of the detail of this can be read in our in-depth report, the Outlook Macro Markets 2020, available as always on zurich.com/MSME.